Hola mi gente, welcome back to the channel. My name is Sean, and this is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, I'm going to show you how to sell a covered call on Robinhood. I'm going to be using my mobile device. It's a Google Pixel 6, but it will work the same for an iPhone or any other Android device. Now, if you don't already have Robinhood, you can download it today on your app store for free and get a free stock worth up to $200 by using the link that I'm providing down below in the video description. You'll get fractional shares up to $200 worth of some blue chip companies like Tesla, Apple, Microsoft, Google, and others. Now, in order to trade a covered call, the reason why it's called a covered call is because it's covered, meaning that you have at least 100 shares per contract or per call option that you're going to be selling. Now, using covered calls is a great way to generate passive income through options trading. It's also a great way to hedge your position. Because of that passive income, you are making money while the stock stays flat. If the stock goes down, you are still generating income. You're keeping all of those premiums. And if the stock goes up, you're still collecting those premiums. If it goes up too much, then you're going to lose out on some potential gains. But the risk there is just that, missing out on some potential gains. Now, I personally use covered calls or a form of a covered call all the time. I use poor man's covered calls mostly, but it's the same principle. And I'll dive into how to do poor man's covered calls in a different video. I also have a playlist where I'm going to be putting all of my Robinhood tutorials in that playlist. We've gone over how to buy and sell stock. We've gone over how to buy and sell options. And this is the first options trading video where we're getting into the specifics of some more advanced options trades. Now, I don't use Robinhood as my active brokerage. Most of my money is tied up elsewhere, but I'm going to show you the process. And I bought 100 shares of SNDL to show you what it's like when you actually own the 100 shares and you can actually do a covered call. Now, to sell a covered call is really easy. Once you have 100 shares of a stock, which I do have of SNDL, all you're going to do is click on your SNDL or whatever stock you have 100 shares of. You're going to go to trade and you're going to go to trade options. The next thing that you have to decide is the strike price and the expiration date. If I go through the expiration dates, I can see that the strikes available for SNDL are 50 cents, $1, $1.50. Well, because I bought SNDL at around 54 cents, the minimum that I can sell a covered call against my position is for that $1 strike. Now, I can go ahead and sell one contract every single week, it looks like, for about $1. To me, that's not worth it. I'm going to have to go out further in expiration to get any kind of premium. So if I keep on going through the expiration dates, and I get to finally July 15th, it looks like there is some premium. The $1 call is trading at $7. So from my $54 position, I can collect $7 in premium by selling this covered call. $7 divided by 54 is a 13% return by selling this covered call. It doesn't seem like much because it's only $7, but it's $7 out of a 54-cent stock price. And you times that by 100, so in total, it's $54. Now, 13% gains in just a couple of months is amazing. And on top of that, you also get the upside. So at 54 cents, if you subtract 1 divided by 54, and then you divide that by 54, that's an 85% gain on top of that. So what we're looking at with this covered call, for everything to work out as planned, and let's just say that it gets in the money by expiration, we're taking on a 13% premium. We're adding that to our bank account today, and the stock needs to move 85% to the upside for that covered call to end up in the money. Now, if it ends up in the money, you don't miss out on those gains. The only gains you miss out on is if SNDL was to go above $1. Let's say it traded up to $1.10. Well, that 10 cents that's above the $1 strike, you would not capitalize on those gains because of that covered call. But you are collecting 13% today for an 85% move to the upside in the next couple of months. And that's why covered calls can be used to generate passive income and also serve as a hedge. And there are much better stocks to sell covered calls against, or poor man's covered calls. SNDL is just so cheap and I don't have a lot of money in my Robinhood account that it's easy to show you how to do it. Now let's say that I'm happy with this 7-cent premium or $7 total. What I need to do to sell a covered call, and this is extremely important, you need to have sell and call. You're selling to open a call option. And then when you want to close out of this, you're going to buy to close a call option. Once you have 100 shares and you're ready to sell your covered call, make sure it says sell and call. Next, you're just going to click on the strike, which is the $1 call, and you're going to click on the price. It's going to say short call below. You're going to hit continue, and here you can pick your limit price. We're going to do we're going to do 7 cents. We're going to do one contract because I only have 100 shares. If you had 200 shares, you could sell 2 contracts. If you had 500 shares, you could sell 5 covered calls. Then we're going to hit review. And then when it's all good and you agree with the information displayed on your screen, you're just going to swipe up to confirm the order. And then you'll wait for the order to get filled and you'll have a covered call. Now there are a few scenarios that can happen once you have a covered call open. If the stock stays flat, that is the best thing that can happen for you, because then you can continue to sell covered calls and continue to collect premium and you're not losing any money in your stock. I take that back. The best situation that can happen is that every single week or every single month that you sell a covered call, the stock gets up near that strike price but does not cross it. And you just keep on collecting premiums and you also get the returns of the stock. When you sell covered calls, you also reap the benefits of dividends because you actually own the stock. So if the stock gives out a dividend, you will still collect that while you're also collecting premiums on those covered calls. If the stock was to go down, it's not so bad. Your shares are going to drop in value. Your covered call is going to drop in value as well. So if you wanted to sell out of your position, you would just close your covered call by clicking buy to open, buy it back for cheaper than you sold it, and then sell out of your stock. Just because you have a covered call open doesn't mean that you're tied to that stock forever. If things were to change and you no longer wanted to own 100 shares of that stock, you could buy to close your covered call and then sell the 100 shares or whatever amount of shares that you have in that stock. Now, the worst scenario, which isn't really bad, is if the stock was to go above the strike price. So like I said, with SNDL at that $1 strike, if it was to go to $1.10, that would be a situation that you missed out on gains because you sold that covered call. Because you're only going to get the gains on the shares up to that strike price. So from 54 cents to $1. Anything above that, you're not going to actually realize those gains. But you have to keep in mind that there is a good chance that SNDL is not going to get to $1 and you're still collecting premiums. But that's, let's say, the risk with selling covered calls. The reason why I love covered calls so much is because you're not going to lose money by selling covered calls. You're just going to lose out on potential returns. But I'm okay losing out on potential returns to get passive income and also a way to hedge against my positions. Now I'm going to show you one other stock and we'll go through the examples just again real quick, just so we can clarify and I can show you the power of some other stocks that I personally sell covered calls against. If we take a look at SoFi, it's currently trading at $10.75. So in order to buy 100 shares, you're looking at $1,075 to get 100 shares. Now the reason why I like SNDL is because it has relatively high implied volatility, meaning that the call options go for a pretty good premium. And being that covered calls is selling call options, the higher the implied volatility, the higher the premium is, the better for you as a seller of options. Now, if we go into SNDL and we hit trade and we hit trade options, let's go for next week's expiration because I'm filming this in the middle of the week. February 25th is only just a couple days away, so we'll go to March 4th. Now, for covered calls, you're going to want to sell a call option that is above your break even. So if we were to buy today, it's $1,075. Now, if you were to get in a position where you were negative, you could still sell call options. But if that call option was to get in the money at expiration, then you would be selling the stock for a loss. There is a way out of that. You can roll options. You can buy back that option contract, sell another one that's further out, and play that game. But that's going to be later down the road once you actually start getting some experience in selling covered calls. I would not recommend that as a beginner. Just sell covered calls for strikes that are above your break even. Even if the premiums are lower, it is what it is. Some money is better than no money. So if we look at SoFi and our break even is $10.75, say that we were to buy it today, you can see that we could sell, let's say, a $13 call for $28. So $28 divided by 1075 is 2.6% returns in just a week and a half's time. In addition to that, 13 minus 10.75 divided by 10.75 is a 21% return on the stock. So in this case, if you were to buy SoFi and sell that covered call, you would get $38 in premium. You could potentially just keep on doing this and keep on collecting premiums. But the only way you're going to miss out on money here is if the stock was to go up 21% in a week and a half's time and go above that strike price. In that case, you're still going to collect that 21% return. You're going to keep the premiums. You're just going to miss out on any gains above $13. So if SoFi was to skyrocket and go to $16 a share, $20 a share, or whatever, you would miss out on gains. That is the risk with covered calls, but it's not really a risk because you're not losing money. You're just missing out on some potential gains, like I said a million times in this video. Now, I sell options all the time. It's what I love to do. It's what I'm really good at and what I focus most of my attention on. I'm trying to find companies and stocks that can generate me passive income while also serving as a good long-term investment. That is my goal when trying to find a stock to buy. Now, just be aware, this channel does have a Patreon. It has a private Discord server of over 500 investors where we talk about this stuff every single day. We talk about the stock market, cryptocurrency market. We talk about the economy. We talk about so much on the private Discord, and I'm on there every single day. So if you have any questions or you want to learn from me or any of the other investors, then definitely consider joining the community. A link is provided down below and it's $5 a month. Also, please consider hitting that subscribe button, ringing that bell, and smashing that like button. And do not forget about your free stocks for signing up with Robinhood via the links down below. Now let me know in the comments section if you like selling covered calls, if you're thinking about trying to do this strategy. If you're thinking about selling covered calls, I highly recommend that you give it a try, but take it slow. Don't go selling a ton of covered calls. Patience is key, and you're going to make mistakes, but you're going to learn from those mistakes as well. And hopefully I was able to provide you some good content. If I was, hit that like button. Other than that, that pretty much wraps it up. The next video is probably going to be on selling poor man's covered calls, which is a way to generate even more passive income because you're leveraging your money. And that's what I really like doing. But it's not for the faint of heart. It's a little bit more risky, but we'll dive into it in my next video. So with all that being said, I thank you so much for sticking around. My name is Sean. This is We Are Investing. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.